Okay, we are set for the next panel. So moving on from LP's perspective about how they foresee growth in India and how the paradigm is shifting and how their perspective is changing across the dynamic macro shifts that are happening, we move on to a private equity panel and listen in from experienced fund managers of private equity funds in India, their views as to from the perspective when they raised their first fund, how things have changed, and especially with the macro shifts, as people are mentioning, their perspective in terms of the strategies that they are looking at, the deployments that they are looking at, their outlook in terms of 2023, and a review by them of what was done in 2022. So I would like to call upon stage now Gautam Mehra, tax leader, partner, PwC, to moderate the session. Gautam. And on the panel, I would like to call Mr. Jayanta Basu, Managing Partner, CX Partners. Manish Kejriwal, Managing Partner and Founder, Kedaara Capital. Manish, yeah. Then we have with us Sanjay Gujral, Chief Business Officer, Everstone Group. We have Shivani ma'am, Shivani, Bhasin, Sachdeva, Founder and CEO, India Alternatives Investment Advisors. We have Sudhir, Variyar, Managing Director, Multiples Alternate Asset Management. Over to you, Gautam. Thank you.
Hello. Am I audible? Excellent. So it's great being here in person after a couple of years. And honestly, I've lost count of the number of times I have got the privilege to moderate this panel. And I'm not complaining at all. But this time, it's different. And I'm not just talking of the composition of the panel. As you see, there is a preponderance of Indian GPs on this, which is a bit different from the earlier years round. Why am I saying it's different this time? POTUS just announced last week that India has created a job for 1 million Americans. Seriously? I've always been taught that it's been the other way around. I was having breakfast with the India head of a fund which has a multi-billion-dollar portfolio, who had just returned from his global partner meeting. And he told me, Gautam, the mood around the table was, this time, India is really different. The PwC Global Chairman, Bob Moritz, was in India, the ET Business Summit. He made similar statements. And knowing Bob, I can tell you, he doesn't make these statements lightly. So in this different environment, we have what I would call the Super Six. Friends, I think these individuals and the organizations they represent, have not just raised capital for India, much needed capital. They have provided partnership and wings to Indian entrepreneurs. And if you see each one of them, they are role models for entrepreneurs themselves. I said it's different. I'm going to do something different. It is said, sitting is the new smoking. So I'm going to be audacious to ask you to stop smoking for 15 seconds and let's stand up and applaud for this Super Six that we have with us today. No, seriously, I meant every one of the three things that I said, not just about raising capital, not just about partnering entrepreneurs, but being entrepreneurs yourself and being role models. So thank you for that. I'll be disrespecting them if I try to introduce them, and I'll be disrespecting your level of awareness, so I'm not going to do that. I'm going to just straight jump into the questions. Manish, you are as much a global citizen as an Indian resident can be. We are seeing so much changing in the world. We just heard. Right? You've seen inflation rates. You've seen the war, apart from COVID. But you also see China one. Where do you see the world headed And more importantly, where do you see India's place in the world?
Well, first, it's great to be here. If I really answer my friend, who I call, by the way, I call him Tom Cruise. There's a reason. Just look at Gautam. Doesn't he look like Tom Cruise? But no, if I was to really answer his question, my other 5 panelists who are much smarter and better looking than me will definitely won't have time to talk. So just to keep it short, I think as far as we're concerned, I think we're in a very, very interesting time. I think it's not just inflation. Inflation is actually one of the areas where India has an advantage. True, our average inflation is probably 6-7%, but we normally average 4-5% in any case. It's the Anglo-Saxon countries where inflation has historically been 0 to 2 or 3%, and or Japan, and now you're seeing inflation rates of almost 2.5 or 3 times that, which is why we're seeing global interest rates where they are, which is why you're seeing such a dearth of credit funding or debt funding for the larger deals globally. But as private equity is concerned, there's a plethora of capital globally and in India. I say it's a very interesting time is because I think it's impossible to say what's in the future. I do think if you move away and look at those old great terms that the Goldman economists, you talk about BRICS. I don't see any B, I don't see any R, I don't see any, well, I do see C and I see an S. So India, China specifically, I actually think this is a decade where our time has come. Having said that, we've had the habit as a country of stepping over ourselves and tripping. That also will happen. But I think we've got an ecosystem, whether it's our entrepreneurs and business houses, or especially our tech digital stack, and see what's happening in India, that despite the tripping, despite that, we're here for a consistent longer time. And that I fully agree with Gautam. I think this is truly a decade that will come. And China, the only thing I'll say is we love beating up on China. If you've seen the last 2 years, and if you see especially the smaller consumer durables, our entire value chain in India is dependent on a Chinese supply. Whether you look at it not only as fans or lights, even if you look at two-wheelers, semiconductors, four-wheeler semiconductors. So I'm actually one who actually wishes for a relatively strong and stable China economically, at least economically. The politics I'll leave to smarter people like Gautam and others. But economically, I'd like to see a strong China. But what has happened is the pivot that we were seeing away from China, from Japan and Korea for many, many years. If you look at the Keiretsus in Korea or the Japanese business houses, that's been happening culturally, socially, a whole variety of reasons. That pivot has accelerated. And for the first time, not because it's a G2G issue, from a market attractiveness, we were selling 2 companies over COVID. Both companies were strategic sales. They finally went to global, it was a sponsor-to-sponsor sale. But in both cases, we had significant interest, Gautam knows both these companies, from global strategic majors. One of them, it was in a packaging business. We had the world's largest packaging player who did not have a presence in India. The CEO flew down for this first trip to India. And I said, listen, you can't be serious. This is about a $300, $400 million opportunity. Why are you coming? And he said, good question. I won't make a difference in the deal. But the reason he was there was because he was also a big packaging, printing guy with global customers. He said, the last few times I've met my largest customers, whether it's a Unilever, whether it's a P&G, he said, I look stupid because I tell them I've never been to India. So he said, even if I end up not buying it, which they couldn't, because unfortunately the sponsor community is paying higher multiples for control deals than strategics are, which itself is another topic for discussion at some time. But that, even though he didn't finally get it, the fact that he was there literally the month before COVID, and then almost when the scare of COVID was on, to me was the best micro representation of how important the country's become. So I think in summary, we will have missteps. I think we're now strong enough institutionally, individually, as each of our firms are, the regulators. Despite that, we will still grow. And I think whether it's India versus I don't look at it that way. I think intrinsically, India has a ton of promise. And eventually, it's back to entrepreneurs. I think we have, it's not just entrepreneurs in India making great companies, but it's also entrepreneurs who are leading some of the best companies in the West Coast and East Coast.
Thanks so much, Manish, for that positive note. Sanjay Gujral, as Everstone, you know, a wise private equity leader once told me, where you stand depends on where you sit. It's a very simple statement, but Sanjay, you're sitting in Singapore, and I thought I'll get your stand on this. How does India shape up in the global world?
No, listen, I think Manish has covered a lot of those points about this is the decade, if you may, of India. It is a decade of Southeast Asia as well. But that being said, let's not get the euphoria into, you know, clouding our brains on that, because we've seen some portions of this story play out just when the BRICS got coined, right? It is interesting times. The momentum is moving towards these markets because the reality is the growth exists in these markets. In addition to the growth existing in the markets, he again made an interesting point. It's a maturing of the ecosystem. You know, when you go back to what happened in the early 2000s, the ecosystem in itself was very shallow and couldn't quite deal with the capital flows. Things right now are very different. So yes, to answer your question, India is looking attractive, but let's have the feet firmly planted on the ground.
Thanks so much. So the hard work has to go on, and hopefully it started in the right direction and has enough momentum built up already. Sudhir, love to hear your perspective on this.
In the bright spot in the global economy, etc., has been made, and my sense is that this has been for a lot of time. We have always talked about the India opportunity, but I think what makes it different this time around is the fact that it seems to be based on some pretty strong foundational elements, in the sense that you finally, unlike about 20 years back when you said that there's no port capacity, there's no road capacity, there's no power capacity, we see that infrastructure is something that seems to be addressed to a great extent. Digitization is something that we have always, I think, even the previous panelist from IRDA was speaking about the fact that on the digitization score there is a significant deepening, all of which is resulting from the growth coming from really deep into the country, into various states, various districts being able to participate in the growth story of the country, and the fisc, the banks, the corporate balance sheets. You find that there is a significant alignment of a lot of forces that make this particular point in time a pretty strong one for India. And I think all the other aspects of saying that demographics, we have a young population, etc., has always been there, but there is today that all of these forces, the strong entrepreneurial culture that's able to now to express itself because of the ability to reach and the availability of capital and so on and so forth. All of that is leading to a belief that this time the growth is going to be a lot more sustainable, and strongly so. And my sense is, irrespective of, while we may talk about global inflation, the fact that there could be short-term volatilities that would come about with interest rates hikes and so on and so forth. But what could it imply, in the sense that instead of a 7% GDP growth, it could be a 6% GDP growth. In nominal terms, it could be 10, 11. But the fact that with all of these forces, as you look into 5, 10 years into the country, and do you see opportunities? And let's not forget that compared to, and even Sanjay mentioned about Southeast Asian countries, etc. But the reason why India seems peculiarly attractive even then is the fact that the size of the economy, the breadth of opportunities that you get to play across sectors, all of that makes it far more meaningful for significant capital to become and deployed in the country, where there is a lot of unity amongst the fact that of the size. So can you ignore this particular opportunity at this point of time on the basis of valuation? I think it is very difficult to do that. Valuations are peak because there is such a lot of optimism about the economy. Unless we fail to realize that opportunity, I think these valuation numbers will be sustained, the capital flow will be sustained, And let's see, going forward, there is, for most of us as funds, raising capital, etc., there's been never a better environment.
Thanks, Sudhir. Well said. I'm going to move track a bit and pull in the other three speakers and really dig into their experience that they've had. In this environment, I think what we'll all love to hear is the learnings and the risks, right? Of course, COVID, I think disruption has changed the term constant in the proverb of being the only, changed the word change in the proverb of being the only constant. And in this environment, what are things that for this audience you would suggest you should do, and more importantly, as Shivani you mentioned, what you should not do? So Shivani, I'm going to pull you into that and share thoughts.
Sure. So thanks a lot. I think I'm going to keep it simple. There's so many of us on the panel, so I don't want to make sure that we all get to speak. But I will focus on three things. And I think I'll start by saying, there are decades when nothing happens, and there are years when decades happen. And to me, the last few years, decades have happened. Decades have happened for us as an ecosystem in terms of learning, what to do, what not to do. It's just sort of all come together, right? And I'm going to, as I said, keep it simple, and I'm going to leave you with three learnings, okay? At least the learnings that I have had. One is focus on exits and exit when you can. So I think what has been really interesting, and if you look at the last decade, right? So let's take 9 to 19. Let's look at pre-COVID, because everyone says, oh, before COVID, that was a different world. Sure, it was a different world, but 9 to 19, I'll leave you with one perspective. India PE VC community had $80 billion of exits, right? 60% of that happened in the 3 years leading up to COVID. So of the 80 billion, 50 billion was exited right before COVID, okay? Then in 21, we all talk about these astronomical, valuations. We talk about unicorns and everything. But the thing that came out of 2021 was $36 billion of exit. Now that fell off a cliff in 22, okay, down to 17 billion. So if you were one of the lucky ones who managed to secure a few exits in 21, you were feeling great. But if you came out of it, whether you admit it or not, that is one very key learning that you're going to come away with. One is obviously invest in companies where you can exit. And second, when the opportunity presents itself, please do exit, okay? The second learning that we had as a firm was a very diligence-first approach. So we had the dubious honor of working alongside a very large partner in a transaction which we pulled out of. Not going to name it, but I will give you a hint. One of the partners in that, one of the co-founders took to LinkedIn and admitted some grave errors, etc. In sort of financial irregularities. Interestingly, he sort of made this admission after the diligence findings came out and so on. Okay. What was the learning there? We were, as a team, and this was the investor team, were very, very persistent. We had the best of advisors, and together we were just very, very persistent in terms of ensuring that we were comfortable, okay? And that is going to just become the norm. We are coming out of this stronger, wiser, and more patient, if you will, okay? And I think the third is a point that you brought up and you alluded to, which I'm going to dig a little bit deeper into, right? And you said change is the only constant. But I'm going to dig deeper there and say change is coming at such a rapid pace, ladies and gentlemen, and the trends are overlapping. So our job as fund managers is going to get much more interesting, much more complex as we look at the next 5 or 10 years. Why do I say that? Because the trends coming out, and COVID has accelerated that. So I'm going to just pull out a couple of things from one of my professors from business school called Moiro Goylan, who's written this book called 2030, How Today's Biggest Trends Will Collide and Reshape Everything. And I'm going to just leave you with 2-3 things that he talks about in the book as to what's going to happen in 2030 and how that world is going to be completely different than what we know it today. So there will be more grandparents than grandchildren in the world. There will be more global wealth owned by women than by men in the world. There will be more computers than human beings. And the global economy will be driven by the non-Western consumer for the first time in modern history. So what we do as fund managers just comes out of that. So I think, again, just to quickly summarize, my 3 learnings: exits, diligence first, and change is coming, it's coming fast and it's colliding.
Thanks so much, Shivani, for stressing on those really critical aspects. Sanjay, Kukreja, ChrysCapital has been around like, I think, nobody else. Love to hear about what to do and what not to do, especially after the recent happenings.
Thanks, Gautam. Thanks for having me here. I would like to just take a few minutes to talk about lessons learned. I think that's the question that you're talking through. I've personally been in the industry for the last 23 years. We've made over 100 investments as ChrysCapital. Wow. We've now reached 78 exits, right? Wow. So over 6.5 billion in realizations. And I'm just sharing this only not for ChrysCapital's perspective, but more from an industry, because we've talked even in the prior panel, and a lot of talk goes about, has India really delivered, right? And I think it's an important point because exits are really becoming mainstream, and I don't think that, that point, especially I would say if you ignore the 2006, 7, 8 vintage when there was a flurry of fund managers, outside of that, I think if you look at the vintages from 2010 onwards, there's a significant maturing, I would say, of the GP universe. People have gone through cycles and negotiated that. Now we are sitting, 13, 14 years post that. And you see for 13, 14 years now, a decade and a half of, realizations, exits, investments, and we see that track record really emerging. And I see that continuing over the next decade. So that's just an overall point, and that's coming through. But coming back to the question of what are the lessons learned for us, Sasha, we have 7 situations out of the 100 where we didn't make money. Okay, I think our job as fund managers is also about avoiding bullets as much as hitting the ball out of the park. And I think we don't structure ourselves as hitting the ball out of the park. You get lucky. Certain times, some great entrepreneurs manage to do that. But our single biggest job actually is to navigate the cycles, the downturns well, right? And for that, you have to have a balanced shoulders on your head and not get carried away by every trend that's always on the come. And because of which you tend to overpay and get overexcited. I think that's been one of the key learnings for us. There is a theme behind those 7 situations that we've actually lost money in. I think I'll break it up into 3 buckets within that. The first bucket is just weaker franchises or weaker businesses. You tend to get overexcited with them just in the middle of an economic boom. And there's phenomenal growth, and growth overexcites you, and then you tend to get in. But some of these businesses have weak return on capital. And if you enter into one of those businesses in a down cycle, is when you realize time's not by your side, right? You actually have leverage built up, you have leverage eating into equity returns. Sectors like EPC, construction, back in 2006, 7, 8, destroyed a lot of capital in the 2008 to 12 vintage, which was the policy paralysis vintage. So that's one sort of big area, I would say, which has been leading to destroying capital. The second thing I would say is just poor governance, right? You all try to do diligence first, and we all try to do that. You're going to get it wrong sometimes. And I think the bigger thing is not just catching the diligence from a fraud and accounting perspective, but also alignment with entrepreneurs. Is the value creation really on the agenda? How do you sort of navigate other air pockets that you may hit, right? Family transition, founder transitions, all those stuff that may happen once you've invested. And so getting that right is actually a very core part of your diligence process, big to begin with. How are you going to IPO? Are you going to go for a strategic exit? That's the second bucket. I think we've had some issues there. By and large, we've called it right, but we've had some issues there. And the third thing I would say is when, I would say investing against the technology tide. Sometimes we as fund managers there were 2 or 3 of those situations for us. get overly excited by also a lower multiple. And we say, okay, this is what we're really looking for, good business, good franchise. What tends to happen is you overestimate technology change in the near term, but you underestimate how much technology change can happen over a 10-year period. And private equity is you want invest for a 5 to 7 year vintage, but a lot can change over 5 to 10 years. It's not that the whole industry needs to change. It's amazing how much an industry can change with only 10 to 15% moving away from a new technology point of view, because all incremental capital starts flowing in the other direction, talent starts to flow in the other direction, your multiple starts to implode, right? So we did have an investment in a newspaper, and the way the world is, consumes its news has changed dramatically, right? So a couple of these examples, I would say these are 3 buckets, I would say. But fundamentally, I want to leave you with one fact that ultimately, if you invest in high return capital businesses, sectors that fundamentally generate business, in place like India, you won't go wrong because you have growth with you. You may overpay, but you'll probably catch up. But when you invest in weaker businesses in the hope of things turning around, the probabilities and odds are that some point you're going to hit an air pocket, a down cycle, and that'll come back to hurt you.
Wow. Thanks, Sanjay. 7 out of 100 is definitely not bad, and that's the LP confidence in you. But some real life learnings from the 65 or 75 exits that you had, right? You said
78 exits.
78. Wow, that's lovely. Mr. Basu, CX Partners has done an equally fabulous job. So, what for the audience?
I wish I could add more. I think between Shivani and Sanjay, they've gone through the entire life cycle. We've spent a lot of time with Sanjay through our early learnings about EPC, etc. Yeah. But I think the most important thing from our perspective is that you have to be patient. The diligence process doesn't end at doing a transaction. The diligence process continues as you sort of evolve right through the entire life cycle. And the third thing that I'd say is that you have to be very careful about technology disruption happening much faster than we actually anticipated to. We've done a couple of transactions where we've lost money, where basically what's happened is we went through the entire commercial diligence, we did the usual stuff. We interviewed experts and they said, technology disruption, if it happens, it's going to happen a decade later. It happened in 3 years, flat. And when it happens, it just changes so dramatically that after a while you're left, pretty much holding nothing. Because when that disruption happens, there is really nothing to hold on to anymore. And that's where you actually lose money. I think overpaying is something which I think India is expensive. Let's face it. We will overpay by global standards in most cases, but if you do it right, it will catch up very, very quickly. And if you can actually help the company along, be an active investor, I think that entire thing of being non-active is passé. You have to be an active right through, pretty much the entire process. Hold entrepreneur. Know the entrepreneur, because I think the entrepreneur is going to make the difference. And if you don't support him at the right time, and be not just a sounding board, but somebody who can actually stand up to him, it's important to be able to deliver the numbers that you really want him to do. I think, so those are just some additional flavor around what Sanjay and Shivani have already, so they've talked about the entire life cycle. So, there's really not much to add, but that's just flavor.
No, it is pretty much to add, and thanks for those comments. I'm going to take one question more of Sanjay, Gujral, and Manish before coming to the others. Sanjay, I know you've been pretty focused on the responsible environment piece, right, and ESG. We all know the E and the S and the G and what's happening on the E, there's some maximum noise created. But on the ground, actually on the ground, how do you see things shaping up? Both on the E, is it just, people are setting their 2070 net zero goals, or is there some milestones being set for next year, next 12 months, 24 months? And on the G, it's very important for investors over here. How have you seen the needle moving on that?
And the name, true that. So listen, I think from our standpoint, ESG is something which is probably at least 5 years old, if not longer. And the world has kind of evolved since. So Neha was on the panel previously, and we've had the benefit of some LPs coming and working with us. Now, each one of us, as we started our journeys, clearly started our journeys from the standpoint of building long-term institutions, right? And as building institutions for the long term, there is a do no wrong and let no wrong happen under your watch mindset that you have. And that is where ESG also started off in its journey. Today that has all evolved to ESG in addition to being a strong risk management framework, be it on the G side or the E and the S side, to actually being ways to look at value creation. I'll give you an example. And we within our private equity business have gone beyond ESG to, while we are not calling ourselves impact investors, we've put in place an impact management framework. And that impact management framework essentially says that for what we do within our private equity business, what are the key levers that we can play on? And we've actually identified 5 key levers, of which 3 will be consistent across each investment. The first, obviously, if you're investing in India and Southeast Asia, you are investing behind growth. And if you're investing behind growth, you will be creating jobs, right? But what about the quality of job creation, what you're doing with those people? That becomes a key lever for us. The second is DEI, or diversity, equity, inclusion more broadly, but more specifically in our context of India and Southeast Asia, the biggest mover is what are you doing on the gender front? What are you doing with your own firm, and what are you doing within the portfolio on that count? And the third key lever for us is climate action. Now, you asked about 2070. Now, clearly, none of us is geared towards running or being in charge of our portfolio for 50, 60 years. We, for instance, invest with a 4-year time horizon. But what we can do is go in, and we've taken this on us, that within the first year of our investment, we will ensure that we put in place a pathway to net zero. That pathway to net zero may well be 20, 30, 40 years. It depends on the circumstances of each business. But we will ensure that we will put that in. We will monitor that through the board of directors. It's their responsibility. And we will transparently share that with our LP so that the onus is on us to make that happen. Now, how does that create value? I'll give you another example. We were investors in a hospital business that we just sold a controlling stake in recently. Amongst various other things that we did with that hospital business, we got them to change their power purchase, or a large chunk of their power purchase, towards renewable sources through a portfolio company from our climate strategy. That move on its own resulted in annualized savings of over $500,000, which means there's $10 million of value creation behind a $60 million investment happening just on that small lever. Of course, you also, with companies that are ahead of the curve, whether you're selling them to global strategics or whether you're selling them to global sponsors, they really need to be top-notch, and you will be well justified to be commanding premium multiples against those kind of investments.
Thanks, Sanjay. I think that's one interesting piece, because in the past, we've always heard that ESG comes with a cost. ESG is creating value. That's clearly coming out from the illustration that Sanjay mentioned. Manish, on a slightly different track, there were discussions, in the earlier panels about the Indian GP community. We've got 5 minutes left, okay? One last question, and then I'll come to the rapid fire, 2 rapid fires actually. Get ready for those. About maturing of the Indian GP community, right? So I know in your earlier avatar, you headed a sovereign fund here in India, and then before you got onto your entrepreneurial journey. So at the cost of doing a self-appraisal, right, what would you say about the maturing of the GP community in India?
I think that's very fair and actually probably a very deep question, Gautam. I would say the easier one looking externally, I think is reflected a lot what Sanjay said, which is exits. I mean, to me, exits defines ESG aside. I think ESG will also get matured, but to me, ESG will really happen when we don't mention ESG. that every investment doesn't need the requirement of a label or a stamp. But I think exits, as Sanjay defined, and many others, including other members in the panel, Shivani and JK talked about it. But I think the single most important thing, and here I would just say the guys who've been around longest has been Sanjay and the firm. And I think for us, it's been a 12-year journey. And now I'm saying about Kedaara. I think the single most important thing is how do you, what we've talked about so far has been the firm outside, whether it's entrepreneurs, which we all believe in, if it's exits, it's LPs. But the single biggest thing we don't talk about on these panels is institutionalizing that change and the culture. So I would say one of the words that we, my partners and I, started with the firm, and it came from a McKinsey heritage, was obligation to dissent. Obligation to dissent is a simple term which says it's not that you have a right to dissent or challenge your seniors. It's an obligation to dissent if you don't agree or believe the facts are wrong. It's a fundamental, it sounds simple, but it's a fundamental thing. And for us, taking that and putting it through, the way our size, we have now grown from, I thought we would never be more than 15 people. We're today 45 people only on one strategy, which is growth and control private equity, not very dissimilar from ChrysCapital, right? But we've added on a significant number of operating partners, operating directors, which are, I had thought we would do operating partners or vertical. We've now taken functional operating directors. And a bit to what JK was saying, right? It's all about how we have evolved over time and how we have to add value in the situation. So it's a much longer discussion. Like you've got a soft point for us, but I think if you get us outside and talk about our institutional maturity, that's been the single most important aspect.
Friends, you've got a discussion for cocktails with this team ready, which is about what Manish mentioned, but very fair assessment, Manish. Thank you for being candid. I'm going to do quick 2 rapid fire rounds. The first one, which is actually of a lot of interest to the audience every year. I'd love to learn the why, but we don't have the time for why. What interests you from an investment perspective over the next 12 to 24 months? It could be a sector, a theme, a industry, or some segment, right? So I'm just going to go quickly. We don't have enough time. JK. Disruption. Excellent. Manish.
Financial services, as always.
Wow. Climate is Sanjay's speech. Excellent. Kukreja.
Control deals. I think that's changing dramatically in India.
Wow. Shivani.
Femtech and women's health.
Excellent. Sudhir.
Green economy.
You've got your bets. You got your bets from the greats, right? My very last question. How do you spend your weekend? I'll start with Sudhir. Quick. No
Duck
thinking.
this. but no, playing with friends.
I'll answer it as well myself, so go ahead. Family, excellent.
Sports.
It shows.
As recent empty nesters, my wife and me are out partying.
Wow.
My youngest son, who's convinced my dog is more valuable than him, so it's trying to figure out the time I spend with the dog and the son.
Priorities in life, yes.
Going through my vinyl collection.
Excellent. And to be fair, I'll take that question on myself. I'm accused of being more horizontal than vertical on weekends, so I'll end with that. But friends, it's great having the Super Six and hearing from them. I would ask you once again to quit smoking for 15 seconds. Let's stand up and give them the applause that they deserve. Thank you for being a wonderful audience. We are on time. One photo.
Thank you. Thanks.